Hello my dear students, today I will be explaining you the solution of 2016 Winter 3.1 regarding cash flow. So let us begin. So this was the mnemonic code to remember the headings of the cash flow statements. You have this mnemonic code. You can see the picture out here. The ostriches are invading France. So ostrich means operating activities, invading means investing, and France means financing. These are the code you need to remember. The mnemonic code for cash flow from operating activities is also here. Now comparatively, cash flow from operating activities has a bit more details to be remembered. So try using this mnemonic code so that you don't have confusion with other headings. So for cash flow from operating activities, in the picture you can see the ostriches are not invading cows. In the previous figure, ostriches were invading France, but in this figure ostriches are not invading cow because they are looking in the reverse direction. So we will use this mnemonic code. Ostriches are not invading cow, so cows don't die. Ostrich no invade cow, cow no die. Just the white colored one, you need to remember it. So no means none, C means non-cash expenses, you need to add plus. If it's income, you need to minus. So just remember C means non-cash expenses or incomes. O means non-operating expenses, income. When it comes to expenses, we'll be adding it back, expenses will be subtracting it. And W means working capital. So all related to working capital changes. When we talk about working capital refers to the difference between current asset and current liabilities. So your components are current assets and current liabilities. Here you need to remember that if there is decrease in current assets or if there is increase in current liabilities, we are supposed to add it. DI. So DI means DI, just the DI. Decrease in current asset, increase in current liabilities, add, else you subtract it if it's not this rule. So this is the code you need to remember in order to calculate cash flow from operating activities. So this is something your statement looks like. This is what will be basically doing by calculating cash flow from operation. First thing, you start off from profit from operation. You need to know the starting point. This profit from operation is derived from your income statement. So if this is your income statement, here revenue less cost of sales equals gross profit. In gross profit we add other incomes, it's 90. You get less expenses, and expenses you have like rent, salary, communication. These are called operating cash expenses. Then we deduct depreciation, less sale of loss and sale of vehicles, that's non-operating loss. Lawsuit expenses, non-operating expenses. Total expenses 40, you deduct, you get profit from operation. So basically here what I'm trying to focus is the profit from operation is at this stage. From profit from operation we deduct the finance cost to get profit before tax, then we deduct tax and we get profit after tax. So when you are starting cash flow from operation, remember that you need to start off from the profit from operation. The second point after that, what we need to do is you need to add up all your non-cash expenses. So here, while calculating your profit from operation, we deduct all kinds of expenses, whether it's cash or non-cash. So when we talk about depreciation, it's a non-cash expenses since there is no outflow of cash. So we are going to add back to profit from operation because our objective is to obtain cash flow from operating activities starting from this point, starting from the point that's your profit from operation. So that's added back here. The second, now you also need to add up non-operating expenses and losses. So you need to understand these non-operating expenses. Now to understand non-operating expenses, first you need to understand what is operating expenses. So operating expenses are the expenses incurred in the normal trading activities, or you can say normal course of business, or in the core operation of the business. So like rent, salary, communication, etc. These are your operating expenses. These are normal operating expenses. Depreciation is also operating expenses, but here it is non-cash, that's why we're adding it back. So this is your operating expenses. Now non-operating expenses means those expenses that are not normal expenses of the business. For example, your loss on sale of vehicles. See, we don't sell vehicles frequently. That is not a normal activity of the business. So loss on sale of vehicle is a non-operating loss. Lawsuit settlement expenses. The company could have to incur court expenses when someone files a case against the company. So that's your lawsuit expenses. The lawsuit expenses are not normal expenses of the business, so those are called non-operating expenses. So if you come across non-operating loss and non-operating expenses, we need to add it back because it has been deducted here to obtain profit from operation, and we are adding it back to get the real cash flow from only operating activities. So here non-operating expenses, example loss on sale of non-current asset 10 is being added back. It is shown as an inflow. The changes in working capital, right? When you talk about working capital changes, remember working capital components are current assets and current liabilities, but in the list of current assets, make sure you don't take cash and cash equivalents. So besides cash and cash equivalent, other current assets needs to be considered. So if there is decrease in current assets, you need to add it here. It shows inflow. So example, decrease in inventory, that's your inflow. Decrease in trade receivable, that's your inflow, you add it. So basically you can understand from decrease in receivables. Here I'll show you an example why it is added back. So let's say trade receivable. Let us talk about trade receivables. So if we talk about trade receivables, the trade receivables are credit receivables. So the opening balance will be on the debit side. So assuming the trade receivables for us is 100 at the start of a year. Now at the end of the year, if you have trade receivable of, let's say, 60, what does this indicate? You need to understand this. Initially we were supposed to receive 100. Now at the end we have 60 as receivable. So it means the balancing figure has been received. The 40, that's your missing figure, has been received. So we write that as cash. And if you see this journal entry, it becomes cash account debit, trade receivable account credit. So here there is the inflow of cash. So now you understand that if there is decrease in current assets, it indicates inflow. Decrease in current assets results in inflow of cash. Same way, if there is increase in current liabilities, that will also result in inflow. Remember this. So example, increase in trade payables, inflow. Now if it's the reverse of this in your question, suppose instead of decrease in current assets you have increase in current asset, take it as outflow. Make sure you put bracket. And if there is decrease in current liabilities, make sure you put bracket. So instead of remembering all the four differences, try remembering only these two. DI, decrease in current asset, increase in current liabilities, positive. Then the next two major components you need to remember is tax paid and interest paid. So tax paid and interest paid results in outflow, so you put bracket. And then when you add up all these datas, of course the bracket means subtract. So when you get this net figure, that's your net cash from operating activities. So net cash from operating activities, if it's negative out here, that is understood by used in, net cash used in operating activities. You can also write net cash increase or decrease in operating activities. increase means positive, decrease means negative. So that's how we prepare cash flow from operating activities. Let's move forward. Now to calculate cash flow from investing activities, very simple. You just need to remember sale and purchase. Sale of non-current assets and long-term investment. When there is sale, obviously there will be inflow, so positive. The reverse of sale is purchase. Purchase of non-current assets and long-term investment, negative. And then interest received and dividend received, you add it up here. Interest received in the sense, let's say you have provided long-term loan to outsiders and then you receive interest, so that's a kind of investment, providing loan to outsiders, long-term loan, and if you receive interest on it, that's your income from investment. So interest received, we are adding it here. Now dividend received could be you have invested, the company has invested in other companies' shares, and then if the other company provides dividend to us, that is dividend received, so that's also dividend received from investment, so that's why it's been added here, 20. So result, you get net cash from investing activities. That's how you get it, very simple. So just remember, non-current assets and long-term investments are part of the investing activities. Now when you talk about non-current assets, those are your both tangible and intangible assets like plant and machinery, your furniture and fixtures, vehicles. If you talk about intangible assets, it could be goodwill, patent, trademark, copyright, etc. Then we go to financing. Financing is very simple. It's related to shares and debentures basically in your question, or it could have long-term loans taken. Debenture is an example of long-term loan. So issue of shares and long-term loans, if you have taken it, there is the inflow of cash, so it's 30, and we also call it issue. Redemption of shares and debentures or long-term loans, if we are redeeming it, it means we are returning it, there will be outflow, so negative. And then dividend paid for shareholders, we need to pay the dividend, so since it's related to the financing activity, dividend paid also comes here, negative. That result, you get net cash from financing activities. That's how we do it. So let us look at an example from your exam paper 2016 winter 3-1. Now so this is the question. Directors of Hank Limited provide the following statement of financial position at 31 March. So year end is 31 March 2016, 2015. You have 2 years data out here. Additional information given. The following information relates to the year ended 31 March 2016. The profit from operation was 30,000. See, we need to start off from profit from operation. It's given here. So very simple. In your cash flow statement, the profit from operation 30,000. Very simple. During the year, non-current asset with a cost of 24,000 and accumulated depreciation of 9,000 was sold for 8,000. The depreciation charge for the year was 12,000, and all non-current assets held at the end of the financial year are depreciated over 25 years using the straight line method. Interest paid for the year was 9,000. Dividend paid during the year was 25,000. A dividend of 30,000 had been proposed at the end of the year. The taxation charge was 20,000. So we have additional information here. Now when you are making your cash flows, normally you will have a major working information related to non-current assets. So you need to work out, because there you need to calculate the amount of depreciation and the sale of non-current assets and the purchase of non-current assets plus profit and loss on sale. Those components will affect your answers. So I am repeating one more time. The major working note will be regarding your non-current assets. So when we talk about non-current assets, non-current asset, you will have to make the ledger, you'll have to work it out to calculate these items. Number one, depreciation. we'll have to figure out what is the amount of depreciation, because depreciation needs to be added back in your cash flow. I'm going to show you that. Yeah, see, up. So you will have to calculate the amount of depreciation, that is depreciation to be added back. Like here 12,000 has been here, depreciation on non-current assets. This is same line, depreciation on current assets 12,000, like that. You need to find out, we'll have to find out how what that 12,000 is. So depreciation will be added back, we know that. Then there could be, you know, sale of non-current assets. When you sell, there will be cash inflow, so you need to find out what is the sale value, how much it has been sold for. And then when you are selling, there could be profit or loss. The profit and loss, it could be either profit or loss, that you will have to adjust. If there is profit, you will have to deduct it. Like here you can see profit on disposal of machinery. Why are we deducting it? The reason why we are deducting it is because this is inside your profit from operation. While calculating profit from operation in our income statement, we add profit on disposal of machinery. Now this we are deducting it because it is your non-operating income. That's the reason. Non-operating income, that's why we are deducting it. Had it been operating income, you would not deduct it. So where there's profit on disposal of machinery, we are supposed to deduct it. Now what if there was loss on disposal of machinery? So if there's loss, you will have to add it back. Why? If you ask the question why, because to arrive at your profit from operation in the income statement, there would be less loss on sale of machinery. That's what we do normally while preparing income statement. So since it has been deducted to arrive at your profit from operation, we are adding it back. Simple reason, it is your non-operating loss. That's how we do. So we'll be calculating depreciation, sale, profit or loss made on sale, and then purchase. The purchase, when you purchase your non-current assets, there will be outflow of cash, which you will have to show in the investing activities. So basically this sale component and the purchase component will be in your investing activities. Let's have a look down here. Yeah, see, cash flow investing activities. Okay, cash flow investing activities, purchase of non-currency outflow, sale of non-currency inflow. That's where we'll be putting it once we solve it. So you need to have this picture in your mind. The reason why we are making laser is to compute the sale and purchase, that's to put in your investing activities, and to calculate depreciation, this depreciation, and the profit or loss, depreciation and profit or loss to be adjusted in the profit from operation, or you can say cash flow from operating activities. So let us begin how to do it. So this is our question. Now let us work out the working notes. So non-current assets, if you look up here, net book value. Net book value means is the cost minus depreciation, or you can say book value less depreciation. So this net book value is not at cost, just remember that. So we have non-current assets. You don't have you simply have a simple block as non-current asset. You don't have different current assets, so you don't need to worry. Everything is to do with non-current asset. Let's look down at an example. During the year, non-current asset cost 24,000 and accumulated depreciation of 19,000 was sold for 8,000. The depreciation charge for the year was 12,000, and non-current assets held at the end of the financial year are depreciated over 25 years using straight line method. So this 2 and 3 is related to your non-current assets. Now this is a part of your depreciation chapter which we study in our AS level. Well, I have made a video regarding the methods of calculating depreciation. If you have confusion, you can go through it one more time. Anyway, here also I will give you a recap of it. So when it says accumulated depreciation, you need to understand that the depreciation is it is prepared under the provision for depreciation method. So under provision of depreciation method, what we do was, this is the picture what we do. We have the non-current asset cost, then you have provision for depreciation of non-current assets, and then you have disposal of non-current assets. You are basically supposed to make 3 ledgers under the provision method. So for non-current at cost, we just record the cost data out here. Every data out here is at cost. In the debit side, you have the opening balance at cost, and then if there is a purchase, that's addition at cost. And the credit side, if there's a sale, you write disposal account for sale at cost value, make sure it's at cost, and then the remaining figure also comes at cost. That's what we do. Then in the provision for depreciation account, what we do is we have opening balance of provision in the credit side. Remember, the provisions are credit, the credit side, and then depreciation during the year, that is depreciation for all the non-current assets during the year, is added in the credit side by writing income statement. Then in the debit side, if there is any non-current asset disposed of during the year, the total accumulated depreciation for that disposed asset is deducted here, this 9,000, and then you get the remaining figure as your balance CD. There's a closing provision for depreciation on non-current assets, that CD becomes BD, and this is how we do. And then for disposal of non-current asset, what we do is here, this ledger is prepared to calculate profit or loss. So basically what we do is, in a debit side, you put the cost of non-current assets, and then in the credit side you deduct the total accumulated depreciation on the disposed of asset. So total depreciation here is 9,000, that you write as provision for depreciation, and then you also put the sales value. What is the price of sales? So you write bank and then put 8,000 here, and then the remaining figure is either your profit or loss. If it's your profit, the balancing figure comes in your debit side. If it's your loss, it comes in the credit side. That's how you solve it. So let us see how to solve this part now. I'm just explaining this. I will show you step by step how to do this. So let me bring my whiteboard down here. So I'm just going to explain how this whole thing has been done. So let us begin. Okay, so first thing you have your, let's have a look at non-current asset at 259, that's 1,000, 224,000. So these are at your net book value. Net book value here. For non-current assets, you need to add cost, you need to put the cost value, so this will not make a difference. So let's look down here. During the year, non-current asset with the cost of 24,000 and accumulated depreciation of 9,000 was sold for 8,000. Let us put this 24,000. During the year, non-current asset with the cost of 24,000 was disposed. Means when you disposed of, it reduces the non-current asset value. So you write here 24,000 disposal account. So this is first step we are going to do here. This way, 24,000. And the accumulated depreciation of 19,000. So accumulated depreciation was 19,000. 19,000 means in the provision for depreciation you will put accumulated depreciation 9,000. You will deduct it from total depreciation. Was sold for 8,000. This is your sales value. This you will have to put here in your sales. This way, 8,000. That's how we do. Then the depreciation charge for the year was 12,000 is depreciation for the year. This you'll have to put here in your provision for depreciation here, 12,000. This way. I'm just showing how each component has been done. Now all the non-current assets held at the end of the financial year are depreciated for 25 years using straight line method. Now this is the critical point where you get confusion here. This part you need to understand, because this working note is quite a tricky one related to this point. Others are easy. So this, what you do is, all non-current assets held at the end of financial year are depreciated over 25 using straight line method. So we know that depreciation is under straight line method. Under straight line method, the amount of depreciation remains constant for all the years. It means whatever assets you have at the end is going to be depreciated for 25 years. Means you will have to multiply 25 into 12,000 to arrive at your cost. here. See, this is your closing balance out here. 25 into 12,000. Sorry, 25 into 12,000. That's right. So when you multiply, you get 3 lakhs. This is the cost of non-current asset at the end, because question is saying at the end whatever asset is held is depreciated over 25 using straight line method. So that means since we were charging 12,000 per annum depreciation, and the straight line method is the fixed amount, so that means if you multiply that, you get your cost here this way. So this part, I hope everyone understood this part, 3 lakhs. So once you understand this, now in your provision for depreciation on non-current assets, what you need to do is, here you need to get this value, closing depreciation. Now how to get this? That's the question we need to understand. So at the end of the year, the cost of non-current asset is 3 lakhs. So if at the end of the year the cost of non-current asset is 3 lakhs, and then if you look in your book value here, the net book value is 259,000. So that means if you subtract 259 the net book value, you will get your accumulated depreciation, that is depreciation up to date. So that is your 41,000. So that's how this has been arrived, 7,000. So that's how we do this. Now when you complete this, what happens is you add this 19,000 plus 41,000, you get 60,000, and then minus 12,000, you get missing figure as 48,000. That is depreciation at the beginning of the year. Remember that in this question we didn't have a closing provision and opening provision, so that's how you're supposed to compute. This is the tricky part. This step, then this step is equal to the missing figure 48,000. Now once you understand this, now this 48,000 will be useful to calculate your opening balance of non-current asset at cost. Now to get your opening balance of non-current asset cost, look at your net book value at the beginning of the year. That's 224,000, you can say 224,000 plus 48,000 you added, you get 272. As we are adding back the accumulated depreciation. So this comes here, this step. Then after this, what you do is you add this total up, it comes to 324, subtract 272, you get 52,000 as the purchase. There's a missing figure done here. So this two is done. Now disposal of non-current asset, what you do is we have put this disposal of non-current assets, you put in the debit side the value of non-current at cost. So usually your non-current asset was 24,000, you put at 24,000, and then provision for depreciation is 19,000, you put it here, and then the bank value is this, you get profit as 3,000. That's how we do it. Now you might be a bit confused to what I said. You can pause the video and look at it. Anyway, I'll just show you one more quick review how this can be done. So see how to do this now. First you do make 3 ledgers this way. Non-current asset, this is at cost, remember that. All the others must be as cost, make sure you remember that. Then your provision for depreciation, I have just write depreciation here. And then your disposal account comes here. So you can initially do your disposal account because all data is here. So for disposal account, in your debit side you put the cost value of the disposed asset. So the cost value is given here, 24,000 here. So you can put 24,000. That's how it has come. I'm just putting the numbers here. You can write non-current asset as it is. Then an accumulated depreciation 19,000. So on the disposed asset, total depreciation is 19,000. That has to be deducted. You put your 19,000. Was sold for 8,000, means you have received 8,000 out of it this way. So you add this up, and then the missing figure you get profit as 3,000. As 3,000. That's how this has been obtained. So first part, work note number 1 is understood. So about what to do about NCA cost. Now this part, this is the one quite tricky out here. Here's my mouse. So for this, what you do is you need to first put the data that are available in the question. Like dispose account is given, so 24,000 you can put here at cost. 24,000 is the cost of asset disposed. The opening balance BD is not given to us. This is quite tricky. And then the CD is also not given to us. It's not given there because this both has to be at cost. Here we have net book value. So this CD needs to be computed by doing 12,000 into 25. So if you do 12,000 into 25, you get this as 3 lakhs up there. This is how this went. This part is important that you need to know. This is given down here. All non-current assets had at end of the financial year depreciated over 25 years using traditional method. So that you need to put here. So when you get these two data, now you still don't have opening balance. So to get this opening balance, you need to first prepare this provision for depreciation account. Here we have opening balance on the credit side, but you don't have the data for this. This has to be taken out. So I just wrote BD. Now depreciation for the year is given 12,000. So 12,000 you will put here. Depreciation for the year, you can look down here. Depreciation charge for the year was 12,000. That's here 12,000. Then now we don't have BD. What you can do is you can get your CD closing balance. You can get now to get your closing balance of provision for depreciation. What you need to do is here we have closing non-current asset cost. So this minus net book value, that is 259. If you subtract this, see 300,000 minus $29,000 give you 41,000. So that comes here 41,000. So this is the part you need to understand, the subtraction part, this part. So once you understand this, you get this figure, and then total depreciation on disposed asset that is given to us. So you put this as well here, 19,000. So now when you have this, you add this up, and then you find the difference amount. You get your opening balance as 48,000. This is the important part you need to understand, 48,000. So after this, when you get this 48,000, now you can finally prepare this one. So to get the opening value of non-current asset cost, you need to add the net book value at the beginning, that is 224. So 224 you need to add 224 plus total depreciation at the beginning, total accumulated depreciation. So that's 224 plus 48, you get 272 here. So 272. So after doing this, you add this total and then subtract from 272, and you subtract 272 from this total, you get your missing figure as 52,000. That's your purchase. So that's how the whole steps works out. Try pausing the video and going through it one more time to understand this working. This is very, very important. Okay, let me move forward. So this was the question, and then this was the cash flow, and this was the working order. Now I'm just going to explain how this has an impact. So once we have understood how to calculate this, now if you look in this non-current asset, there's a purchase reduces outflow, it goes in investing activities. So if you look down here, investing activities, in your investing activities 52,000 has been negative. So this is done. So others, nothing to look at here. I'll look at purchase or sale. You just need to get purchase sale from this one. Now from provision for depreciation, we need to look for depreciation during the year. There's 12,000 that has been added here, 12,000 up here. And then disposal account, there's either profit, loss and sales. So there's a profit out here, profit goes up here, this profit disposal that has deducted. And then bank sales is an inflow, 8,000 down here. In here there's a positive inflow. That's how it has worked out. So back to question. So we have understood how to do 1 and 2. This is a simple thing, simple adjustments which is understood. Now profit for operation is done, we have put it. Now interest paid, you know where to put interest paid and dividend paid. So interest paid and dividend paid goes in our financing activities, so that's where we'll take it. let's have a look at it. So if you're looking at cash flow, interest paid 9,000, interest paid 9,000, tax interest paid is here, dividend paid 25,000, and then tax 18,000. Now for tax what you need to do, you need to look in working note number 2. So this is how tax ledger is made, in case you need to understand this. Interest paid is okay. Tax charge was 20,000. So to make your tax ledger, you need to write provision for tax account, opening balance in the credit side. This comes from your question. Look in your current liabilities, other payable taxation, you have 18 opening balance, closing balance 20, 18, 20, and then tax for the year 20,000. This 20,000 you put it here, and then the missing figure comes to 18,000. That is your tax paid during the year, 18,000. So normally tax is paid of previous year, so you can assume that 18 will be the paid amount. So that's what 18,000 is in your tax paid. If you look here, tax paid 18,000, cash outflow. Interest paid now 9,000. Interest paid 9,000 is understood. So dividend is 25,000. You can look down here, dividend paid 25,000. And remember, you don't need to deduct proposed dividend. Proposed is not relevant for the question. You just need to deduct the dividend paid. Proposed is simply it's just a proposal, so there is no outflow of cash. So what else was remaining now? Now if you look in the question right from beginning, let us look at from right from beginning. So non-current assets, we have done this. Now let's see current assets. See, current assets, inventory and trade payables are part of your working capital. You need to adjust it. Cash and cash equivalent, you don't need to do anything about it. And then you go to liabilities. In the liability section, taxation, we have already done it. It goes in a separate component, so that's done. So remaining we have trade payables and bank overdraft. So first let's look at the working capital. Remember that in working capital concept we studied that if there is decrease in current asset, if there is decrease in current asset and increase in current liabilities, we are supposed to add it. So let us look at it. Inventories is increasing, 102, 128, increasing. It means it is not decrease in current assets, so the difference amount we'll have to subtract. So inventory is going to be minus. Inventory is going to be minus. I'm just going to write here minus with the difference amount. Trade receivable is increasing, so trade receivable also increasing. Trade receivable is also your current asset, so this is also minus since it is not decreasing. Let's go down to liabilities. Trade payables is decreasing. Since trade payables is decreasing, we are going to do it minus, because increase in current liabilities add. Trade payables are current liabilities. Had it been increased, we would have added. Since it's decreasing, so minus. Now bank overdraft is a part of cash and cash equivalent, so this is not going to be done anything here. I'll show you where this needs to be done. So let's look at our answer. Inventory, trade receivable minus, trade payable minus, so all are minus. Okay, everything is minus. Let's have a look at the solution. So inventories minus, you can see there, increase in trade receivable minus is the difference amount, and then trade payable minus. See, all those are minus based on it. So after that is done, now if you look at a question, we have completed all except cash and cash equivalent, and we have used, we have adjusted for the working note as well. So now I'm going to explain the full cash flow. So profit from operation we have done. Non-current assets, depreciation on non-current assets, you understood how this has come. Profit and disposal is done. Increase in inventories, increase in trade receivable, decrease in trade receivable, done. So you add this up, you get cash flow from operating activities. Add from 30,000, 12,000, minus. So if there is bracket, you subtract. If it's positive, you add. The net result is minus 8,000. That's your cash flow from operating activities. There you deduct interest paid and tax paid as per the format. You get net cash used from operating activities. Bracket means used. So you have this 35,000 negative. Then cash flow from investing activities, you solve it, you get this, and then you solve cash flow from financing activities. So for cash flow from financing activities, let's have a look at the question. So cash flow from financing activities, you need to look at shares and long-term liabilities. So shares and debentures basically. So here share capital is here. Share capital is increasing, so plus the increased component. Share premium also increasing, so plus 15. And then down here, anything else? No. So it's not there. So let's have a look at it. Do you have debentures? Non-current liabilities here. Non-current liabilities, bank loan, it's increasing. Increasing means issue, so plus. So share capital and bank loan should be increased along with share premium. Let's have a look at the answer. Increase in issue of shares plus share premium plus increase in long-term loan plus. See, that's how it has been done. So I hope you all understand this. You can pause and calculate and check your answers. So so that's how you solve it. Now your question could be, let's have a look at the question one more time. So dividend paid, you have, everything is done, all is done. So now for this retained earning, you don't need to do anything because it's already set here. Dividend paid in the year is 25,000. If it was not given, you need to make a laser and calculate the missing figure. So since dividend paid is already here, we don't have to worry about it. So that finishes your cash flow calculation as your final answer. Now let us look at additional question. Explain the difference between statement of cash flow and cash budget. So if we have to explain this, it would be like this. Answer A here. Cash flow is based on summarized historical data. So it's based on all the historical data, past event for a period, and provides a link between cash and cash equivalent balance at the start of the year and balance at the end of the year. That's correct. So it, cash flow statement simply acts as a bridge between your opening cash and cash equivalent balance and the end cash and cash equivalent balance. Whereas cash budget is a predetermined or expected data for future period, usually presented in a columnar format. So cash budget is simply it's a prediction of your cash flow in the future that we'll be studying later on in a new topic. So just remember, cash budget is a prediction of future cash flows and it's presented in columnar format. That's what it said. Saying that, I forgot to tell you this one. Let me have a look at this. I forgot to end this part. So net increase in cash and cash equivalent, there's 37,000. I hope you understand this, how this comes. You simply add A plus B plus C, you get 37,000 negative. Then you add opening cash and cash equivalent, 14,000, that's given in your question. 14,000 is here. Opening cash and cash equivalent, opening balance 14,000. So you add that up. When you add that up, you get 37,000 minus plus 14,000. If you add it up, you get 20,000 negative. That's your cash and cash equivalent at end. Now this 23,000 must be equal to your closing cash and cash equivalent. So if you look in a question, if you look up here, there is no closing cash and cash equivalent. It's not here. But if you look down here there is 23,000. Now why it's here is because you have a negative balance, negative cash and cash equivalent. There's bank overdraft 23. That's why it's down here. Had this been positive, it would have been up here. So 23,000 negative, that's why, and the answer should be 23,000 negative. Yes, it is correct. Remember, this ending balance must be equal to your question's ending balance. So let us have a look at second question. First is done, B is done. Explain with reference to statement of cash flow whether handling limit has a strong or weak position. Okay, number C. Now based on our cash flow answer, we need to explain this. So let's have a look at how this has been done. Number C. So I'm going to explain to you based on this one. Hang limited is a weak cash position as there has been decrease in cash over the period of 37,000. So if you look at the solution down here, see a net increase in cash and cash equivalent. Look at the final answer, 37,000. We have negative cash outflow, negative cash balance. So it means the Hang Limited has a weak cash position. See, weak cash position because we have negative cash balance. So obviously you can mark this as 1. You get 1 mark for saying this. This can be partly explained by the purchase of non-current assets 52,000 and the dividend paid 25,000. So what is the reason for negative 37,000 negative cash? Is because if you look at the major activities here, one, there is purchase of non-current asset worth 52,000, means this is one big outflow of cash. And then if you look down here, just look at the minus component here, there is dividend paid. You are paying dividend, so because of dividend being paid and purchase of non-current assets, you have negative cash outflow. Now you could say this as the major issue. However, the net cash from operation is also negative 35,000, mainly due to negative movement in working capital totaling 47,000. So however, the net cash from operation is also negative. If you look from net cash from operation, from our operation activities, there is negative cash outflow. It means there is no positive cash flow from our normal activities, normal core activity of the business. From the normal core activity of the business itself, there is negative cash outflow. So you have negative balance out here. Now the main reason is due to your movement in working capital. It means your working capital management, there's a problem in your working capital management, because if you look down here, see, increase 14,000. If you add this 26,000 plus 14,000, you get 10, 2, 3, 4, 40 plus 7, you get 47,000 because of these three components. These are part of your working capital. So due to improper management of working capital worth 47,000, if we add it up, there's a negative cash flow from operation. So the main reason for negative cash from operation is due to mismanagement of your working capital. That's what it's trying to say. Altogether, despite making a profit from operation, see, despite making profit of 30,000, increasing the loan and issuing shares, the net movement in cash and cash equivalent has been a decrease. So although they are making profit of 30,000 and you are issuing shares means you are collecting money, and you are also issuing loans means collecting money, still there is negative cash outflow. So it means the business has a weak cash position. Here what it's trying to say, you have a profit and also you are taking loans and you are issuing shares, means collecting more money, yet you have negative cash flow, means that's not good, it's trying to say. So altogether, despite making profit from operations and increasing the loans and issuing more shares, the net movement in cash and cash equivalent has been a decrease. Therefore, the business is a weak cash position. It cannot continue to keep issuing shares or taking loans and taking out loans, and the movement in working capital needs revealed. So here what I'm trying to say, you cannot issue shares every year and you cannot take loans every year to manage your cash flow. So that's not a solution. You need to work out in your working capital. This working capital needs to be managed properly so that from your core activity there should be a positive inflow of cash. That's what it's trying to say. So overall, we say that Hang Limited has a weak cash position, and that was for 4 marks. So 4 marks. Here you have 1, 2, 3, 4, 5. 1, 2, 3, 4, 5, 6, 7 points. You can write any 4 points to get marks. Very simple. Okay, let's go to number D now. Prepare summarized schedule of non-current assets as it would appear in the notes in the published account for the year ended 31 March 2016. So that would be like this. I explain with the work note 1. So notes to account is also a part of your financial statement. I mean, it's a major part of your financial statements, like your cash flow. You need to prepare it as per your accounting standards requirement. So in your notes, you need to show the details of non-current assets. Like out here, if you look up in this question, this is at your net book value. Now this has to be shown in the working notes, or you can say notes to account, to show how this has been arrived at. So now basically we are going to show that. We're going to show a solution at the end. So notes to financial statement and non-current assets. Schedule of non-current assets, you write this way. You write non-current assets, you write cost at 1st of April 2015. That's your cost at the beginning. So cost at the beginning, this 224 is not a cost, but we have made the ledger. Look at your ledger, the cost is 272. So you need to put this here. So basically what you're going to do is you're going to add the debit side and subtract the credit side. So 272 is here. Add your purchases at cost 50,000 is done, and then dispose 24,000. 24,000, you get your cost at 31 March 2016, $300,000. So basically it's a ledger but in your vertical style. So this way. So it is just this, you can simply understand. Now for depreciation, in the same manner, if you look at provision for depreciation, you need to put your opening balance. The opening balance is 48,000 there, and the provision during the year, this is depreciation charge during the year. You add this, and then you deduct the depreciation on the disposed asset, 19,000. So deduct this 9,000, you get depreciation at the year end, 41,000. So then you write net book value at the beginning, that's 31 March 2016. This is at the end, okay. Net book value at the end means 259. Now this 259, how did it come? You look up at the end value, 300,000 minus 41,000. You subtract it, you get 259,000. Net book value at the beginning, so you just deduct the beginning value. Beginning cost is 272, beginning depreciation 48,000. Deduct it, you get 224,000. That's how you do it. So you have 12,025, 3 lakhs. That's the working note out here, which I showed out here. So this is your number D answer. You are supposed to know this style as well. So notes to account, to prepare schedule of non-current asset, do this way. It's number D. Finally we go to number E. So what's in number E? Advise debtors of whether or not they should apply the international accounting standard when preparing the published account. Justify your answer. Now that is very simple. International accounting standard you must follow. You don't have a choice regarding that. So you could write these answers. The debtor should apply the international accounting standards so the information contained within the published account is useful and aids making economic decisions, is comparable, is consistent, understandable, relevant, and reliable. See, it's for 4 marks. 1, 2, 3, 4, 5. You have more than 4 points. So they should follow it because it helps in making economic decisions. It's comparable. You can compare between 2 years or 2 business. It's consistent, means it's the same over the years. It's understandable, that you can understand. It's relevant and reliable. Or you can also write this: if economic standards are not complied with, the external auditor will qualify the audit report as financial statement do not show true and fair view. So at the end of the financial year, the auditor, he reviews the books of accounts, he reviews the financial statements, and then he puts in his opinion. So while doing so, if international accounting standard is not followed, he will qualify it as not fair and view. Qualify it as not fair and view means he will indicate that the accounting standard has not been followed, which means the information, the decision taken from the information derived from the financial statements could be misleading, which could have an impact on the users of financial statement. So that's very important issue out here. So 1 marks for advice, 3 marks for justification. You can add any 3 points and then justify it. That's your number E. So saying this, I have explained to you the question paper of 2016 winter 3-1. You may go through it and let me know if you have any questions. So saying that, I will close off. Thank you everyone.